Hello and welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Trey Bino. I'm a financial planner with TC Wealth Management and Avisa Wealth. For more details or to send in your questions, check out the show notes at treybino.ca/podcast. And if you want to learn more about me, start with episodes 1 and 2. This is the 9th episode.
I think it's the 10th.
No, not even. It's the 11th episode.
Oh.
The 11th episode.
Who's keeping track?
Yeah, 11th episode. And this episode is on investing versus paying down debt. And I know a lot of people, this is one of the areas where people can get very opinionated. We'll go over the numbers. That's kind of the cool thing about what I get to do is I have cool software and programs that I don't think I've actually shown you some of this stuff before. So we'll take a look at just a quick example that I threw together, and we'll go over some key things to think about when you're trying to decide whether you're going to focus on paying down debt or investing it, right? First things first, I don't care what the numbers say, and the numbers would prove me right anyway. But if you have...
I was like, you don't care what the numbers say?
To a degree. If you have like bad debt, like consumer debt.
Give some examples.
Credit card debt.
Okay.
Like high interest debt, you pay it off. Like there is no, should I invest or should I pay it off? When, you know, it's so painful to watch people have, like they'll have like an emergency savings account. And then they'll also, like, let's say there's $10,000 in their emergency savings, but then they'll have $15,000 of credit card debt. So they have the savings account sat there earning 0.0001. And then they'll have their credit card debt costing them 25% a year. Don't do that. Just pay, like, I'm saying it's thousands of dollars that people throw away doing this for no benefit to themselves. Purely psychological benefit.
Well, that's what I'm wondering. Why are people holding on to debt?
Because they will say like they like to see it there, like it's
the debt.
No, the savings, the cash, right? Because it makes them think that. Yeah, I'm sure you can relate. Yeah, but they like to see it there when in reality it's just costing them money. If you have debt like that, you pay it down. You'd be done with it. I don't care if you put your account to zero every single month trying to pay off the debt. You can always go re-borrow against the line of credit or whatever it is, whatever that bad debt is. Get rid of it. Do not be sitting on a ton of cash, especially in revolving debt where you could just go and, like, if you really needed that extra $5,000, you can
put it back on the
credit card. You know, like there's no real downside. It's purely psychological. Just stop doing it. Don't do it. If you take one thing away, you can end the episode here. Just stop doing that. If you know anybody that's doing it, stop it. Just pay it off. Don't sit there with cash, earning nothing while you're paying a ton of interest on debt. Okay, first round
out
over.
Of the way.
Okay, good. So when I'm talking about the investing versus paying down debt debate, I'm mainly talking about low interest debt, mortgages. Mortgages are the biggest one that people will have to decide this between. And there's a few factors to keep in mind. One of the biggest factors, we'll look at a few, but is risk tolerance and financial literacy, because they tend to go hand in hand. If you're choosing, not every investment is equal. So if you're choosing between investing in an income fund designed for retirement versus paying down your mortgage, it's more likely than not, and I'll show you the numbers actually, but it will show that you're more likely to end up better overall by paying off the debt. But if you're investing in a 100% equity portfolio because you're comfortable with market risk versus paying down the low interest debt, very different story. Okay, so actually we'll start with that. So this financial planning software, it's called Conquest. It's actually one of the cool things. But I created this character. See the person's name?
Marge Simpson.
Marge Simpson. Yeah. So this individual, Marge, is the important thing is that they're the same. So I kept like I created two people and their spending is exactly the same. So we're really dealing with apples to apples comparison. So
Okay.
I had this person, I think they earn $150,000 a year. They spent $50,000 a year plus any debt payments, and they saved absolutely everything else.
Okay. Yep.
And they save pretty efficiently, so they kind of max out their RSPs and their TFSAs, and then they shift over to other things. So the question was, in this scenario, did it make more sense for them to pay down the debt or to invest it? Right, that was the question.
Mm-hmm.
It'd be great if I had my summary here.
Pulling it up on the computer. But nobody can see this though, so
Yeah. Okay, there we go. So you see this left-hand column here is their age. So the top one here is that they paid towards their mortgage. So this individual, normally they can save about $20,000, $21,000 a year. Is that gap. And I put that the person that's paying down their mortgage, instead of putting that towards investments, they just pay off. They put that towards their mortgage instead.
like they put principal
Yeah, put
payments
principal payments on annually onto their mortgage. So you'll see that. So this is their age. So you see starting at 35 years old in the left-hand column here. On the right side, you'll see liabilities. So this is their mortgage. And then you'll see their total net worth. Make sense?
Yep.
Okay, so in the first year, this top section is pay down mortgage, and this bottom section here is invest.
Okay.
So in this first
So these
year,
are two different people?
yeah, they were the same person, but one person decides, two different scenarios.
Okay.
Right? So this is how I would compare, let's say I was working with a client to compare two different paths. This is how I would do it, right? I run them both and then you kind of compare.
Yep.
So you see on the right, you see net worth. You see the net worth column.
Yep.
So it's at 35 years old. So the person that invests has a $30,000 net worth. The person that pays down their mortgage has a $30,000 mortgage net worth. Sorry. They're both $30,000. But as you get further and further away, so now at 45 years old, do you see the difference?
Oh yeah.
We'll say it.
So sorry. So at 45, sorry, I just got to follow the line. They have $615,000 in net
and this
for their
is
net worth.
Pay down mortgage. This is the person that pays it down.
Yep, they're paying down their mortgage,
But
and
their mortgage is at what?
59,000.
Okay, and then the same age, so 45 on the person that.
So their net worth is 680,500.
Yes. So what's the difference? So it's
Don't make me
it's about $65,000 at this point, but they still have the mortgage.
Yep.
Right?
So their mortgage is still 348,000.
Yeah. Whereas the other individual, how old are they when they pay off their mortgage? So they're 47.
47. Yeah.
When they pay off their mortgage, and then they have a net worth of $776,000 at that point, and at the same age, a 37-year-old has a higher net worth at 887, but they still have the mortgage, right? And the idea of the people that want to pay down their mortgage, they think, okay, well then I can catch up after the fact.
Wait, I know the answer already. That's not how this works.
No, but yes, you're correct. Don't jump ahead. Come on. Okay, so let's skip forwards now. First of all, both of these are very good decisions. I would like to preface that with both of these are great decisions.
Like paying off the mortgage or investing?
Either. I often say to clients, I try to get them to improve their financial position with 30% of their income every year, right? So yes, for some people that will be paying off their debt. For some others, it'll be paying down a mortgage.
Yeah.
So at 65 years old, well, actually, no, let's look at when the person pays off. So the person that invested finally pays off their mortgage at 60 years old.
Yep.
And they have a net worth of what?
2.9 mil.
Yeah, 2.9. Almost $3 million.
Almost $3 million.
Yeah. And that's at age 60. And then this person managed to like close the gap a little bit, right?
Yep.
Because they're sitting at 2.8.
Yep.
So a $200,000 difference.
Yeah. Which when you're looking at the big numbers, you're like, oh, that's not that bad. But then when you think about it, that's
Still $200,000, right? Uh, and this is where the person that was paying down didn't do it perfectly. Like I didn't put them making the interest tax deductible. I didn't do all of that stuff. It just very simply one invest, one. And this is where the financial literacy comes in, because this number is not accurate at all, because there is a big range. There's a range of outcomes, I would say. And the way that we look at it in my industry, we do basically we run this scenario a bunch of times, so over 1,000 times in different market conditions, basically, and see the probability, like the range of outcomes.
That makes sense, because it's like, as much as the software is cool, it's like the real life isn't like so.
Yeah, it's not the same amount of earnings every single year, and like it's the markets, right? It goes, there's good years, bad years, etc.
Well, even in people's lives, things change too. So it's like you can be like, oh, if you do this every single year, then you're going to be here. It's like, well, what if? Yeah.
So and so the range of results is kind of what I like to look at. So, for example, this individual that invests, when they retire, or sorry, at 65, let's use 65 years old, they have a net worth range between $2.3 million and $5 million, basically. And the individual that pays down their mortgage, let it load. Okay, the individual that pays down their mortgage has a net worth between 2.25 and 4.3. So $700,000 on the high end and $200,000 on the low end.
Yeah, I think that was
what the number was now. 2.3.
Oh,
so $100,000 on the low end. So what it shows, though, is that you're more likely to be right by picking the investing route than picking the pay down debt route. Doesn't mean that's what you should do. As I said, both great options. So I just kind of wanted to, the numbers will show time and time again, if you're willing to invest in a almost 100% equity portfolio, it's better off to invest over paying down the debt. It's called leverage. Everybody knows about it, but there is a lot of risks that come with that, because you're basically, if the markets drop and you panic, you don't have a house paid off, right? So it's kind of, it can be like a mental safety net to pay down your mortgage, and for some people it makes sense. It all depends on what you're trying to achieve, right? In this case, it actually does make a big difference for this individual for their retirement. I'm not going to go into this, but the success score for paying down their mortgage is actually the retirement would be like in jeopardy versus the person that invested, and that's just that $200,000-$300,000 difference switches it from in jeopardy to on track. So
that's kind of interesting.
Such a small, and I didn't set out to make that difference. It just happened to be in this one case. Oftentimes, it won't matter to the person's end result. And oftentimes, you don't have to do both. You don't have to do one or the other. You can do both. Like, you can say, okay, well, I want to get rid of my mortgage quicker than maybe 25 years. So maybe I'll go half-seas. And put half towards the debt and half towards investing. It's just, I wouldn't recommend somebody go all in on paying down the debt over investing.
Yeah, like I'm not going to invest at all until this debt is paid.
That is the wrong approach.
Because that's the time thing that I was mentioning earlier, where it's like, oh, I'll just catch up. That is not.
And you also lose a lot of flexibility, right? Like there is an element of safety kind of to having money sitting in a TFSA that you can access whenever you need to, right? So yeah, there's that time thing. But so overall, that's kind of, it makes sense to invest over paying debt, but you'll probably likely land somewhere in the middle, depending on lots of different things. So one of the big things, we'll go through a few things. So the first thing would be interest rates. And we kind of already touched on that a little bit. This only applies to low interest debt. Don't go with high interest debt.
You're like, let me reiterate.
Yes. And I've seen, I know it sounds crazy. I've seen stories of people where they will go max out their credit cards to put it into Bitcoin. Right. And it's just like, and the issue is, they say the worst thing that somebody like that can happen to them is them be right, because they believe it's their, like, they have something special about them, and then they go do it again. And the same attitude that allowed them to take $50,000 of credit card debt and turn it into $500,000 of like assets is the same reason they'll take that $500,000 and get back down to 50. Yep. It's that same
gambling.
Yeah, 100%. It's like, gambling. So this debate is only relevant to low interest debt. Ideally, debt that you can make tax deductible, which actually that would be the last episode that went out, would be the tax deductible debt. So maybe that should make sense to people, which would be great. Okay, and then there's the guarantee versus the market risk. And as we all know, markets go up and down.
Yep.
So when you're paying off debt, that's almost like a guaranteed return on money, guaranteed reduction in the amount of interest that you're going to pay versus taking the market risk.
Yep.
And that market risk reduces the longer the time frame. So when you're younger, I will recommend a lot more to pay down. It's not to pay down debt. Opposite, to invest. Yeah. When you're younger, I recommend to invest over paying down debt a lot more, versus when you are almost at retirement, especially if you need the cash flow during retirement, etc. Lots of reasons to want to. I would recommend more somebody focus on paying down their mortgage. So there's that side of things as well. And that's just an objective risk versus there's the emotional side. So let's talk about the emotional side and the psychological benefits, right? What have you maybe heard about? Like, because this is one of those nuggets of wisdom that like grandparents like to pass down to.
What, like pay off your mortgage?
Yeah, right. Oh, yeah. Like it's one of those things. Dave Ramsey, so he's huge on very anti-debt.
Yeah.
I feel like he has like a personal brand to protect. I've heard him say some wild things. I watched a video where he said if somebody was to lend you zero interest $1 billion and you have to pay it back in 10 years or something, zero interest, would you borrow it? And he said no. Crazy. Like, guy clearly has an image that he's trying to show. I would say though that if I had to pick between somebody paying off their mortgage as quickly as possible or blowing it on cars, I'm going to pick somebody paying off their mortgage as quickly as possible and not using credit cards and staying out of debt entirely, right?
Yeah.
There are levels to somebody's ability to handle financial strategies and handle debt appropriately. If you're the type of person that can't handle debt appropriately, pay down the debt, get out of debt, pay cash for everything. Don't use a credit card, cut it up, get rid of it.
Okay,
if you're the type of person that can do it properly, they're great. Love credit cards. Put everything through credit cards.
Yeah.
Or you also have never paid interest on credit cards. So, there's, two sides of this.
Yeah. I just have a question. So you're saying like, oh, if you're the type of person, maybe this is just like another kind of like side note, but you're like, if you're the type of person who is using credit cards and can't control your spending, like, stop. It's a part of me is like, well, obviously they can't, because that's the psychological problem. Like, they're in a bad habit. Do you know what I'm saying? It's like, I guess as an advisor, how do you make somebody realize that? It's like deep down they probably know, but do they know, or are they just
Well, it'd be my job to tell them if they don't think their strategy is appropriate for them, right?
Yeah.
Like oftentimes with people where they get a lump sum of money or like they get inheritance and they have nothing else to their name and they're trying to choose between paying off their mortgage or investing. oftentimes I'll push them towards paying off their mortgage because they clearly haven't been able to save money up until now. If we put this into a TFSA
You're
or an
gonna take it
RSP,
out.
they're going to take it out
Yeah.
and they're going to spend it on something else. So again, it's not comparing apples to apples at that point.
It's like you have to know your client, or
yeah, you have to know yourself. To make this decision, you have to know yourself. If you're the type of person that struggles to keep money around and not spend it, well, then you can't keep money around and not spend it, and you're better off just getting rid of your mortgage, because at least you're less likely to go and remortgage your home. Still tons of people that do, so even then it doesn't help, and it probably would have been better to invest. But it's as soon as you add the emotional side, the human side of this debate into it, it's just so person to person.
Yeah. That's what I was thinking. Like, yeah, it takes a level of somebody who's actually going to change their behavior, which is
I wouldn't. There's tons of people. I think a lot of people assume that everybody out there is bad with money. That is absolutely not the case.
I don't think that.
I think a lot of people do. I think a lot of people just, like, especially people that aren't great with money, they just assume that everybody is in the same boat as them. And that couldn't be further from the truth. Like, I've met some extremely head on their shoulder type people when it comes to finances that didn't really know what they're doing, but also made no bad mistakes and have been able to do really cool things, right? Like, there's a lot of people out there that do a great job of managing debt and managing their personal budgets and stuff, and just need strategies to enhance that, to optimize it, right? So,
yeah. Well, okay, so quickly recapping this section, I guess, because what would the psychological benefit be? Like, just for this situation, it's like you can tell yourself your house is paid off.
Yeah.
Is that the benefit?
Yeah. A lot of people, like, it's a huge goal for a lot of people, right? Is to
Yeah.
pay off your house and own it outright. You'd be able to do that. You wouldn't have a mortgage payment. That means that you would think to yourself, okay, well, if I got into a bind, at least I don't have a mortgage payment that I have to pay for. I'm not paying interest, right? So less interest that I'm paying. That's a good thing. There's definite benefits to it. If for some reason the bank like calls in your loan or something like that, and you can't, or the interest rates go up, like we just had. If you don't have a mortgage, who cares? So there's things like that. There's definitely a psychological benefit to it.
Yeah.
It's just that when you look objectively, when you look through what's actually happened throughout history, even through all the big hikes in interest and things like that. Because remember, this is not a decision that you're going to make one year and
switch it up.
Like, I'm talking about like making a core decision for the way you manage your finances, versus if you're going to be trying to time the market with whether you do this strategy or not. Don't do the strategy. It's not worth it. You're probably going to end up in a worse position by doing something like that, because you have to about to stick to it through all of the time, through all the good and all the bad.
Yeah.
Same with any strategy. Same when I talk about the reason we have variable mortgage rates. It's like, we will stick to that strategy through the good and through the bad.
Yeah.
And fortunately for me, I've done the math. I know that we're still ahead, even though we just went through really high interest rates.
Yeah.
We're still ahead because of it. So kind of that long-term view is, you have to have that if you're going to take this approach and not pay down debt. So again, either one of them is great. Pay down debt.
Yeah.
Invest. Great. Both great options.
Yeah.
It's just, if you're trying to optimize, there is a right and there is a wrong option there.
Yeah, that makes sense. Like, the numbers don't lie.
Yeah. And I mean, if you're losing sleep because you have a mortgage still, well, then
it's not worth
it, right?
Yeah. So, it's funny how it's like people sometimes get hung up. This is my argument on the optimization thing. That you mentioned it in a previous episode where you're like, oh, I know you don't like the word optimize. And I'm like, well, I don't not like it. It's just that with money, people are like, the math is the math, right? The numbers are the numbers. But I don't fully agree with that because of this aspect of it. Like you said, if you're not sleeping at night because you have a mortgage, who cares? Like, if you're not happy, what's the point?
See, I'm so torn, because I agree with you on one hand, and then on the other side, this isn't really the argument I would die on for paying down debt versus investing. This is not that argument, but I would say there are some points where education is really important,
Yeah, I would
where
agree with you on
people
that.
are concerned about things that they shouldn't really be concerned about, or worrying about things that they shouldn't be worrying about, and they use that as a reason, or other advisors will use that as a reason not to put somebody where they should be. And a really easy example of that I'm thinking off the top of my head is like an RDSP, where like a registered disability savings plan is like for a child, you're talking 40, 50 years into the future. Is this money is that's what it's for. It's when it's going to be used. That person, the least risky option is going to be a high equity content investment.
Yeah,
And
which is labeled high risk,
no,
right?
it's not even, it's labeled medium, but everybody that hasn't invested before will walk in and say I'm low risk. The majority will say I'm really low risk. So I think for those times, it's really important to educate appropriately, and for advisors to push back.
Yeah.
Right? To your job is to be the voice of reason in your clients' lives. It's not to make your clients feel better.
Right.
And you to understand when it's appropriate just to make your clients feel better, and when it's appropriate for you to put your foot down and say, no, you need to learn about this because it's important and the benefits are significant enough that I know you don't want to learn it. Tough cookies. You got to learn it. That I think that's a really important skill that a lot of advisors don't possess.
For sure, because you're like, I think there's kind of two types of people who are really good at making people feel good, and people who are really good at looking at facts and figures, right? Like,
Ideally, you want to be a bit of both, but
exactly. But I mean, most people lean more towards
absolutely they do.
one or the other, right? So it's like you could have a really good advisor and they never make you feel warm and fuzzy. Like they don't make you feel
But
good.
they get the results that you're
But
looking for.
exactly.
Or
Or you're like, I have this,
unfortunately,
my
you
friend.
have this buddy advisor that you've been working with for however long, and then you look under the cover, and somebody like me comes along and ruins it all for you because they say, "Hey, this is the situation. This is what you missed out on because you chose, well, not you chose, because the advisor chose to protect your feelings over looking over the facts." But again, we are way off track.
Sorry.
This is not the
Keep
topic
going.
that I would say is a make or break for that type of comparison, where I would say if an advisor isn't telling you not to invest
Yeah.
over paying off debt, it's like, no, both are great options. Just if you're looking to optimize. So another thing to think about is the liquidity and flexibility side of it. So a lot of people have this idea that they need to invest for retirement. I challenge people to reframe that and just, you want to invest, not necessarily for retirement. A lot of the money is accessible, but you want to invest. It's another source of income. It's a way to make your $100,000 of income suddenly be $200,000 of income because you have income sources from outside of you going in trading your time for money, if that makes sense.
Yep.
So there's an element of flexibility that either one provides in different areas. So by paying down your mortgage, maybe you'll be getting like a potential, like a line of credit or something that you'll be able to use for a business venture or for an opportunity. On the investing side, by investing and putting money aside and still keeping the debt, you will have money that you can use potentially for an opportunity down the line if it approaches yourself. What you find is that people that do very well financially, and people will look at their position and say, oh, they got lucky. It was because they were in a position to get lucky and to take advantage of opportunities that come their way.
Yeah, just the way you're talking about that, where you're like, just invest. I've heard you say, like, invest for opportunity.
Yeah.
I feel like that's a good way to look at it. It kind of it reframed my mind, I guess, to kind of focus more on that. It's like, it's not about one specific thing, if that makes sense. It's like, you don't know what's going to happen in the future, and you might want to take advantage of some something later on, something might just fall into your lap. And that's exactly what you said, I guess, with the luck thing. It's like, oh, you're so lucky you could do that. It's like, well, it's not 100% luck because I put myself in a position to be able to take advantage of the opportunity that's arisen.
100%. Like you think back on like 2008 when there was tons of like markets were down, etc., and people buying up property at really low cost. The fact is, even if the markets were down and you pulled money out, but you'd been investing over the last 20 years, it was still worth way more. And you going and buying a property in Vegas for $20,000 that's worth 200 later, yes, maybe people will say you got lucky, but you was in a position to be able to do that because you had built something on the side.
Yeah.
And either way, you'd be able to do that because if you had a mortgage there that you've been paying down, you would have that room, that gap in your home to take out equity to do something like that. Again, depending on which route you go, just do one of them. One of them. Don't do none of them. Do one of them. Yeah. At time horizon, we already touched on this a little bit, that the investing is better the longer the time frame is. So if you're having this choice and you're younger and you're willing to learn and you're willing to be comfortable with the market ups and downs, then investing, typically you should lean towards that. Again, you can always, so something I did recently with a client was they received an inheritance and they were looking at this option exactly. Do we pay down our mortgage or do we invest it? And they'd never invested before. They were in their late 30s and it was a substantial amount of money, enough to pay off their mortgage. And we decided to pay off their mortgage and start them investing. And the reason I did that was because I didn't want them to be terrified of the markets. As we know, like a 5% movement on $20,000 feels very different than a 5% movement on $1 million, right?
Yeah.
Like it's still 5%, but the numbers are so much bigger that it can very easily scare people.
Yeah.
So what we said was, I told them I would choose investing. You're young enough that it could make sense for you, but I don't think you have the experience to do it. So we're going to start off paying down the mortgage and we will revisit this in a few years once you have started investing, seen market movements, etc. Fortunately for them, or I don't know, unfortunately, the day this was beginning of April. So like the day afterwards, everything happened with Trump and the tariffs, and the markets dropped like 15% over the next week. So I'm very glad that we did decide to do that, because that would have been about as bad of a start to investing as you could possibly imagine.
Hey, it's only up from here, I guess, right? Like, well, maybe. But I don't know. I guess you can't really say that, but
it's just it'd have been a bad start. So there was that side to it. They didn't have to go through that and experience it. But the plan is to revisit it in the future, and if they're comfortable, well, then we'll do that. We'll invest instead of paying off the mortgage. So that is one thing I would say, that there's no final thing. It's just what you're comfortable with, and maybe you're not comfortable with it today. Do one of them, right?
Yeah.
Worst case scenario would have been them sitting in there sitting in a savings account while they decided for 3 years whether they're going to pay off the mortgage or invest.
Yeah,
that's worst case scenario. So.
Who would do something like that?
You would definitely do something like that.
Yeah, I know. Not anymore. I'm trying.
Better. There you go.
Yeah.
And then, as I mentioned, you can just blend it. You can just do both. Don't have to do one or the other.
Well, yeah, it kind of sounds like that's similar to what you told them to do, right? Like you're gonna start investing.
Well, we paid off the mortgage entirely, so
okay.
Yeah, we paid it off, so they don't have it, and then we're investing that amount, and then we're gonna revisit it at a future date. And then there's the tax implications, which I think this is a last thought behind it before everything else, like after everything else, because if you want to learn more about that, go back to episode previous one to this one. I don't know what it was.
Wait, that was the budgeting one before this one. Episode 9 is the tax.
Episode 9. Yeah, go back to episode 9. You learn a little bit more about debt structure. But if you can do it in a way that makes it even cheaper, like the cheap debt already even cheaper to invest, it would make a ton of sense for you just to learn what you don't know and to invest it, because again, it makes a big difference long term. So each person is going to be, your situation is going to be unique to you, and what you decide to do will be unique to you. But numbers are the numbers. We know that over time, it makes more sense to invest over pay down the debt, but doesn't mean it's right for everybody. Both great options. So
Makes sense.
I think that's everything. That's everything I wanted to cover. What do you think about my planning software?
Yeah, pretty cool. I like that you can run different simulations, because we always say like, oh, you can't live a parallel life. You can't, you know what I mean? Everybody makes these any decision. You make decisions all the time, and you only have one path to live through, if that makes sense. Like once you decide, it's like that's going to impact the trajectory of your life every time, right? So it is kind of cool that you can kind of be like, okay, if I do this,
what's the likely outcomes? Yeah.
Here's what would probably happen in 10 years. Here's some other things to consider, blah, blah, blah. I like that. You know me.
Yeah,
because
even this one I can see. So I put this person dying at 95, and I can see the median results of what the estate could be worth. So granted, they're both not incredible retirements by any means, but the middle result of the pay down the mortgage was $205,000, like the ending estate at 95 years old they've spent, and the person that invested was 470,000 was the middle result. So you can see that small difference, which might not seem like a ton, impacted their entire life.
Yeah.
Like, that's pretty crazy to think about, that something that would be what seemed like such a small difference that they did between the ages of 30 and 47 years old has an impact that big on their entire life.
Yeah.
I feel like that fact of that is like not a superpower that I get to play with, but like it's a perspective that not a lot of people get to have.
Yeah.
Of just how impactful decisions that they make today are on their whole life, the way that, and the trajectory and the way that it works out. So
yeah, exactly.
I don't know, it's cool. I enjoy it. But anyway, we'll leave it there. That's everything. So we'll see you in the next one. What's the next one on? I did write a list, so I can kind of maybe talk about it. Next one is optimal asset allocation. This is when we're focusing on like the difference between somebody investing 20% in bonds versus 20% in stocks, versus how to figure out how you should be invested. So we'll look at, just like today, we'll look at kind of what the numbers show us, because there's tons of actually really good articles and education pieces that professors and stuff it's a very well researched topic. So we can see what the data shows us, but then there are some constraints. So we'll discuss that as well. Okay, we'll see you in the next one.
Bye.
Thanks for listening to this episode of the Plain English Finance Podcast. Trey Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities are offered through Aviso Wealth, a division of Aviso Financial Inc.